Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Seema Mody, in today for Bob Pisani. I'm joined by Dave Nadig, Managing Director of ETF.com, and John Davi, Founder and Chief Investment Officer at Astoria Portfolio Advisors. Now, guys, markets are staging a modest rebound from Friday's losses, but remain on edge after inconclusive trade talks and weakening global data. Plus, with the odds of a rate cut later this month creeping steadily higher, the hunt for yield is still going strong. John, what are some of the best dividend plays right now?
So, I mean, broadly speaking, in my personal view, anything like stock dividend yield, bond yields, they're all pretty much crowded, expensive, vulnerable, if I'm being honest. Now, when I look at the 10-year, right, it's yielding 1.75, I think what a lot of investors do is they say, okay, I like this high dividend yield ETF, it yields 3-4%. That's great, but just keep in mind that carries a lot of risk, okay? Like 10-year is a risk-free asset, and now you're going into the stock equity space, which carries a lot more volatility. If you must own a high dividend yield ETF, what I would say is load it up into a portfolio construction tool, load it up into a risk model, find out what your sector weights, what your exposures are. Three that I'll highlight is, and I'm not advocating these, but I just want to alert the viewers to the risks, okay? HDV, 21% energy stocks. It's a lot of risk for me. VYM, it's got 18% in banks, okay? DVY, it's got 40% in banks and utilities. So in my personal view, what we use is DGRW from WisdomTree. This is more of like a dividend growth, high quality ETF. So it screens for companies with above average ROE, ROA, and above average earnings. And the idea there is that strong fundamentals can eventually lead to high dividend growth.
So John brings up some interesting points, Dave. Should you look to the traditional sectors like utilities and real estate for yield, or transition into banks and energy, other sectors that may offer a yield not as high as real estate and utilities, but there is a yield?
Yeah, I mean, I think that may be a better play. If you look at some of the funds that have very attractive headline yields right now, like the Global X Super Dividend Fund, yeah, that may have a 7 or 8% yield on it, but it's actually been a terrible performer, I think, for a lot of the reasons John's talking about. Dividends as sort of a proxy for cash flow, as a proxy for quality, can make a lot of sense. If you look at First Trust Dividends Fund, FDV, this year, one of the biggest sets of inflows we've seen, it's got like a headline yield of 3%, which is very market-like. Yeah, it's beaten the S&P handily. So I think thinking about dividends not so much for the coupon yield like you would for bonds, but as a proxy for quality is probably a better play.
What about looking overseas? Emerging market debt on average, a yield of 6%?
Yeah, I mean, this has been one of John's go-tos. You want to talk about emerging markets dividends?
Yeah, I mean, largely speaking, we like EM, we're overweighted. I think, most of the US markets are kind of getting to be fair value. So we use EDIV, which is another one of these dividend growers, and it screens out specifically for companies that have stable earnings, stable dividends. So we like that. It trades at a discount to EEM. EEM's like 13 PE. EDIV is like an 11 PE ratio. On a one-year basis, EDIV has outperformed EEM. So it's a little bit of a higher quality EM tilt.
Even though there's yield, there's always that risk with emerging markets, slower growth, and that trade dispute between the United States and China.
Yeah. I look at EM, margin of safety, value. I actually think the U.S. is riskier just because you've had this incredible run the last 7-8 years, and you're trading at a pretty high valuation level. So I kind of think that EM is less risky to some degree compared to the U.S. market.
As to where yields go from here, Dave, we have the European Central Bank meeting on Thursday. We may get another cut deeper into negative territory. What does that mean for the overall trajectory of global rates?
Well, it just means that you're really going to have to be struggling if you're trying to actually live off these, right? The idea is that people living off the coupons from bond portfolios, that's pretty old thinking. At this point, you've got to be thinking about total return. I think we are going to be in a flat to declining interest rate environment. I see no reason that that's going to turn around at all. So what you're looking for is what's going to pop when we get some relief, whether it's Brexit relief or trade tension relief. We need things that are going to rally quickly off those, and that's not going to show up in coupon payments.
So if we do get that relief, do you see the 10-year headed to 2% before the year end?
Yeah, if there's risk on, I would expect yields to rally further.
All right, your top pick in this space?
I think FDV, the First Trust Value Line Dividend Fund, would be the one that I would go to.
Is that the Super Dividend one?
No, the Super Dividend one is from Global X, has the big coupon yield, but has been a pretty consistent underperformer.
All right, we'll leave the conversation there. All right, as the battle of the brokers heats up, Charles Schwab firing the latest salvo in the fight to attract and retain clients last week by announcing a move to fractional investing. And Dave, what does this mean for the ETF industry, and will we see other rivals follow suit?
Well, so I think yes, I'll answer the last question first. I think this is setting the new standard for brokerages in the space. Okay. It's commission-free and fractional shares. What does that do for ETF investors? Well, obviously it gives you a lot more flexibility, right? If there's an ETF out there with a $150 price and you only wanted half a share, well, you'll now be able to do that. It certainly makes managing a more balanced portfolio easier at smaller asset levels. But I think the interesting question is, what does it change about the dynamics of the whole industry? ETFs traditionally haven't had any presence in 401ks because of the fractional share problem, because you can't dollar cost average your $200 out of your paycheck across 10 ETFs. It doesn't work. Now it could work. So I think it could open up that market. The flip side is, this is a big opening for so-called direct indexing. Folks that want to put together portfolios, not of ETFs, but of individual stocks that look like index investments. That's where I'd expect Schwab to go next.
John, do you carry a similar view?
I would push back a little bit in the sense that, so the mutual fund industry has been handling fractional shares for a while, so it's good that the ETF ecosphere is now kind of catching up to that. I do think that there's something about like younger millennials that want to buy, half a share of Google and Facebook. Right now, if you have $100, you can basically buy one share of 87% of the Russell 3000 index. So you can get most, of the Russell 3000 index with, without having to deal with fractional shares. But look, it's a net positive, I would say, overall, but I don't think it's going to encourage more kind of younger millennial investors that want to invest and buy half a share of Facebook.
Yeah, I don't think that's what it's really about. I mean, that's going to get a lot of headline risk or headlines, and certainly if you look at some of the competitors here like Robinhood and Acorns, that's the market that they're focused on. So I can see why people are thinking about that, but I actually think the longer term play here is for folks like Schwab and competitors to start running these massive portfolios of hundreds of stocks on a fractional share basis as part of their robo-advisor platform, right? It disintermediates the entire package product business. So I think this is early days. I think it's very exciting, and I think it's very bullish for investors in general.
Well, what about John's initial point about millennials, the younger generation, investing in a different way, perhaps active versus passive?
Yes, certainly that's true. And if you look at, Robinhood, you can go to RobinTrack and see what everybody's buying, and that's sort of fun and entertaining. But long term, the real assets in this business are going to be through wealth management, through 401ks, consistent investment programs. All of those things get easier with fractional shares too. So while the millennial story will get some headlines, there's a much bigger structural story here as well.
Well, what about an ETF Edge? Have you noticed a difference in opinion from your younger clients that are looking to allocate more of their capital as they rise up at their firm, putting more of their salary into stocks, trying to create more customized products for that generation?
Yeah, and this has been a real problem because the normal answer for a 25-year-old who would come to me would be, well, make sure you max out your 401k, right? Take advantage of tax deferral first. That shoves people into mutual funds, right? Very difficult for most investors to buy a single share of anything in their 401k, an ETF or a stock. So I really do think this cracks some of that open for that audience as well.
All right, well, shifting gears here, let's hone in on factor investing. The market's wild swings have investors flocking to low volatility funds. One factor that's proven to be a major growth area for BlackRock. Holly Framsted joining us now, head of US factor ETFs at iShares. Holly, it's good to see you. For those of us who may not know, can you briefly explain what exactly factor investing is and why it should be attractive to investors?
Yeah, so factor investing is not new. They're broad and persistent drivers of return and very simple, intuitive investment concepts that virtually all of us are investing in today. Think about buying companies that are underpriced relative to their fundamental value. That's value investing. Buying companies with strong balance sheets and stable earnings is quality investing. These investment characteristics are embedded in things that we already own. So all that has really changed is that the ETF structure has democratized access to these drivers of return, and improvements in technology and measurement have allowed investors to now see what they own and understand what's driving their portfolio over time, which has really helped, as you talked about, with defensive positioning. It's helped investors understand how to shift allocations in their portfolio in an environment that has been quite uncertain.
So what are some of the top picks or areas you see opportunity?
Well, we've been talking with investors really all year about building resilience into their portfolio, and so quality and minimum volatility investments have been particularly popular. As you mentioned, minimum volatility USMV as a standout iShares ticker there. It's actually the fastest growing ETF globally this year, which is remarkable given that it's not market cap weighted. And so for me, that really indicates to us that factors have become mainstream.
Is there a risk here that this is a little bit trendy? I mean, USMV and its competitors, that whole low vol space, it's pulled in something like $25 billion in flows this year. It's one of the big growth stories, really the only big growth story in the quote unquote smart beta space. What happens when all that money comes out? Is the performance of these types of products really dependent on those flows?
Well, I think there's a difference between talking about upside performance expectation and protection built into a portfolio. Most people are buying minimum volatility strategies or quality strategies because they're concerned about where the market is going to go, and they're really worried about downside protection. So clearly, the biggest risk to investing defensively within equities is that you miss out on some of a potential bull market run. But as you were talking about interest rates earlier, I'm not sure that we're in that environment today, and so what's the risk to missing out a little bit on the upside? I think it's probably far lower than the risk of participating fully on the downside if you're not positioned defensively.
And how do you assess whether a company is low volatility?
Well, so you can look at traditional volatility metrics of individual stocks. Our portfolio in particular aims to balance exposure across sectors and industries. And so as a result, we're investing in some high volatility stocks and some low volatility stocks to the extent that they diversify one another. So really we're delivering in USMV a portfolio that is designed to drive market-like returns over time, but with substantially less risk, taking advantage of correlations.
In terms of sectors, is it mostly consumer staples? I would imagine less tech, which tends to be a bit more volatile.
Yeah, the beauty of USMV and why I think it has been such a popular asset gatherer is that the sectors are actually constrained to be in line with the market plus or minus a couple percentage points.
Right,
So,
and we were just talking about the problem in dividends,
Yep.
right? You can end up wicked overloaded on financials or anything else if you don't have some sort of guardrails there. So I think that's been a key to the success for sure.
exactly.
Good discussion. That's going to do for us on ETF Edge. John, Dave, and Holly, thank you for joining us today, and thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday, same time, same place. Have a great week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.